we're going to start to talk about monetary policy. Monetary policy can slow down the economy if inflation gets too high. Most nations have a central bank. Ours is the Federal Reserve. The chair is currently Jerome Powell. It has a complicated structure. 7-person board of governors, and then 12 regional Federal Reserve banks, each of which has a president. Decisions about monetary policy are made by the FOMC, the Federal Reserve Open Market Committee. The FOMC includes the 7 governors, plus the president of the New York Fed, plus 4 out of the other 11 presidents of the regional Federal Reserve banks. And those rotate. It sounds really complicated, and it kind of is. But more important is to note who's not on the FOMC, nor in the Federal Reserve System. Not the Treasury Secretary, not any politicians. It was meant to function away from politics. Presidents get to appoint the governors of the Federal Reserve when those positions come up. Each president of each regional Fed, though, is selected by the regional banks. It's rather insulated against much politics. The Fed has 3 vital functions: monetary policy, financial stability, and providing banking services to banks and the U.S. government. Financial regulation is really complicated in all the details, but from a very high-level perspective, banks in the U.S. are regulated by the U.S. Treasury, the Comptroller of the Currency, the Federal Reserve for the big banks, the National Credit Union Administration for credit unions, and any of the 50 states for small banks. Yeah, that's the less complicated version. Then there are non-bank financial institutions. It gets really complicated. The trade-off for the banks is they get a level of supervision, but they also get backstop against bank runs. We talked about those when we were talking about money earlier. The 2 main policies to prevent bank runs are deposit insurance. If your deposits in the bank are under $250,000, then you're fully insured through the FDIC, the Federal Deposit Insurance Corporation. The other main policy against bank runs is the Fed is the lender of last resort. The Fed can give money to the bank if the bank needs it. That's why after the 2008 financial crisis, some financial institutions bought a bank because they wanted to make sure they'd be eligible for a bailout if things got tight. The main tools of monetary policy are open market operations, change the amount of bank reserves, changing the reserve requirements, changing the discount rate, and quantitative easing, particularly setting the interest rate paid on reserves. Open market operations are determined by the FOMC, but the open market operations are executed by the New York Fed. That's why the president of the New York Fed is always on the FOMC, because they're the ones who actually do the job. Open market operations are buying or selling U.S. Treasury bonds to or from the big banks. Often these are what's called repos, which are repurchase agreements. Instead of explicitly setting an interest rate, the idea is if I buy something for $100 and after a year I pay back $104, maybe we have a contract that says exactly, I'll buy that, then that's like a 4% interest. You don't have to call it interest. It may be useful in various scenarios to not call it interest, but it's essentially an interest rate. That's called a repo or repurchase agreement. The ultimate point of open market operations is converting bonds, which cannot support more lending, into reserves, bank reserves which can support more lending. We talked about the money multiplier, that bank reserves can be multiplied in a way that plain old bonds just cannot be. Often these open market operations are just used to smooth seasonal variation, short-term disruptions. They're meant to be almost invisible. But other times they represent policy changes and are highly visible. Back to our T table, we got this really simple bank, 100 million in deposits, 5 million in reserves, 45 million bonds, 50 million in loans. We'll suppose there's a reserve requirement of 5%. So this bank is in equilibrium. If the Fed were to buy 3 million of bonds, then the bank has 3 million fewer bonds. So the second line goes down by 3. But it gets money from the Fed, so it has $3 million more in reserves. Its total assets don't change. But now the bank has extra reserves and would like to lend those out, assuming confidence is good. As the bank makes more loans, this would start the money multiplier process. More reserves typically mean more loans, which typically mean more deposits. In reverse, if the Fed were to sell $2 billion of bonds, then the bank would pay for that with its reserves. It would have $2 million fewer in reserves, but $2 million more in the bond categories. Its assets would be unchanged, but the composition would change. Since the bank has fewer reserves, it'd probably borrow reserves from another bank and reduce its loans. It probably wouldn't call in loans, but it would slow the pace of new loans or slow some rollovers, get some additional reserves. That sets the money multiplier process in reverse. Fewer reserves, fewer loans, fewer deposits, less money. To summarize, in open market operations, when the Fed buys bonds, this raises the money supply, and vice versa. When the Fed sells bonds, this lowers the money supply.